everyone, and welcome back to the Ask Avidian podcast. This is Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions, and joining me today, Robert Palmer, our Head of Financial Planning. Robert, it's been almost exactly 43 days since we did our last podcast. In a show of solidarity, we're doing our first podcast back the day that the government reopens. I think, coincidentally, but, just the timing worked out well, and we thought we'd get back on the mics today to talk about some things that have happened, but it's been a little while. So before we get into the shutdown, one thing that, happened to me over the last couple of weeks, and, things didn't happen as they do, and so will admit that, I am not somebody that is Johnny on the spot when it comes to reviewing my monthly bills, especially when it comes to the credit card. One of the things me and my wife do is we, everything is shared. And so we share a credit card statement, and sometimes that statement gets rather long with charges that I don't recognize, but I just assume that they're from the other side of the spending equation. And so I don't worry about them too much. But occasionally when I have some free time, which I happen to have some free time last week, I decided, okay, I'm going to look at the credit card bill and just make sure everything's, recognizable, for lack of a better term. And so I was going through and I saw some charges, and then I saw, a charge from a service that I had signed up for early in the year, 2025, so not that old. Used it for a few months. It was something that I was doing with my kids, so athletic training service. Used it for a couple months and then canceled it, or thought I canceled it. Apparently I deferred it for a couple months, and then that service came back onto my credit card. So 6 months later, I'm paying for this service, kind of an expensive service, and noticed it on the credit card bill. And so I guess, the way I was thinking about that is like, bill pay or bill audit. And, it's a problem for me. I'm not a family office unto myself, but I can get myself into trouble with overspending and not being diligent in watching my expenses. But I would imagine that, our clients have that issue from time to time. What advice would you give them? Would you give a client that, may be struggling with some of those situations, but doesn't want to print out a 10-page credit card bill every month and go with a red pen line by line and make sure they recognize it? What do you tell people?
Well, first of all, I will say that even though you're not watching your credit statement every month, which you probably should, but even though you're not doing that, the fact that in your free time you dedicated that time to looking over a credit statement, huge green light.
Pat on the back.
Pat on the back. That's a good one.
Fist bump.
And I will say, particularly for business owners, if you talk to a business owner, the way they run their books, they're typically looking at every line item to make sure their business isn't overspending. That's exactly how personal expenditure should be addressed. There are certain tech software offerings, like, for example, I'll just throw one out. Quick and Simplify will cost you less than $100 a month. You can upload all your accounts to it. It'll track all your transactions, and if there is a odd transaction or one that's stopped and started or anything like that, it'll flag it and bring it to your attention. And to be honest with you, with all the subscription services and all the pay over times that people are now doing, it's very hard to pick up on these things unless you're watching it every day or at least every month and going through the line items one by one. So I'm a huge proponent of engaging software, engaging technology to help automate some of these things. And I think that it's easy savings.
That's technology you can use for business. You can use it on the personal side too, though?
That's predominantly actually for personal.
Okay.
So Quick and Simplify is a.
I'm taking notes.
Yeah, take notes.
So you guys can't see that.
That's the personal. I will say where an organization like Avidian, for example, comes in with their family office experience. The idea is to marry the two. So whether you're a business owner and you got some personal financial things, or perhaps both, we're able to provide a unified financial hub so you can track both and know when something's amiss, because there's somebody that's a second set of eyes looking at these things rather than you having to do it yourself. And I think that is a huge advantage in today's world, to deploy technology and have someone who's a subject matter expert looking over these things.
Yeah, and we talked about family offices a couple months ago, before the government shut down. Hopefully none of the family offices shut down in solidarity, because that would be pretty problematic. But, we talked about family offices, kind of the overall, like, what's a full service family office look like? And more importantly, what does it cost? What kind of a drag on your overall portfolio result can that end up, materializing to? But I think, you've been doing some work just on understanding, like, the suite of services that family offices provide. Why would somebody want to start a family office in the first place? And then trying to pick apart, like, what are the most important things that a family office can do for an individual or for a family or for even multiple families, or multi-generations in the same family. And so I think this bill pay thing was kind of one that rose to the top, right?
Yep.
Where, a lot of low-hanging fruit. We're talking about it more on money kind of going out the door, right? Auditing the bills that you have. But you were talking about it from another perspective as well on the bill payment side, right?
Yeah.
So how does that help a family manage their finances?
Well, it's actually kind of funny. My significant other works at an organization where she has to handle distributions for bills all the time. And one of the common things that happens is providers change. You have auto payment already going out. And so she's scrambling all the time to try to make sure that the right providers are getting paid and old providers are not getting paid. And you'd be surprised how often that comes up with everyday people.
You know what I find too? When you continue to pay somebody that you no longer use, they never tell you about it.
No, they don't.
They never tell you about it.
They don't. It's like if the government owes you a refund or the IRS owes you a refund, you probably need to file for it to get it.
It's your job to remind them.
That's right.
That's a good point.
And I think it's important that you highlight the family office experience, because I think a lot of those family office offerings are starting to become table stakes when it comes to providing a good experience for clients. And I think Avidian, for example, is a little bit ahead of the curve on this, in that they know that they're going to have to provide these services to keep attracting and retaining the clients that we want to work with. So you mentioned bill pay. I mentioned unifying the professional and the personal from an economic standpoint. So you have a centralized hub to see what the financial picture looks like and how it all ties in. And I think the other thing is cash flow. So it's kind of funny because on the personal side of things, cash flow is the very first thing that financial planning looks at. What kind of income is there? What kind of expenses are there? What kind of avenues or sourcing do you have to pay bills? But very rarely are business owners able to perfectly identify or trace where their cash flows are going or coming from in their business. And it's no fault of their own. They're wearing, 16 different hats, managing a ton of different people. Yeah. And I think one of the easiest value adds that an organization like an RIA, a registered investment advisor, can do is just provide an interface where you can sync up those QuickBooks or you can sync up those financials of a business and the personal financials, and you can see where all the cash flow is going, what the estimated tax payments are going to be, what bills are getting paid, who is paying them, where is it being paid from, and providing that organizational structure, it gives you the greatest ROI you can imagine. No, it's not 100% return. It is time back in your day. The one thing that you can't go back and get. So I think that in and of itself helps justify exactly the value we bring, and I think that others are going to have to catch up to that to remain relevant.
Have you had any aha moments where you're working with a client or a prospect and you walk them through some of these analyses and they kind of look at it and be like, oh, now I need to take action on something?
Yeah, it's actually kind of funny. The big action items are always like, that's interesting. We'll have to talk more about that. That's definitely something I want to move forward on.
And that's code for, I didn't recognize that expense. And it was thousands of dollars and I need to get rid of it, right? I need a refund.
And there's always a little bit of a pause.
Yeah.
Whereas if you look at smaller things like, hey, we noticed that there was an off-cycle payroll adjustment that was made last month and it went out to pay this bill and we don't recognize the sourcing. It was $50. All of a sudden, it is action that day. We are going to save that $50.
Okay. And then there was a time too where cord cutting seemed like it was going to be something that saved cost, right? And I think it just opened up, like, if you're not paying $100 for it, if you're paying $20, $25, you'll take an unlimited amount of those services, and they show up everywhere.
Oh yeah.
And so just kind of like, looking at those, death by 1,000 cuts types of $50 charges here and there that, they can just add up. And a lot of times you pull your your statements up, or you look at something on a screen, right? And you just look at, just like Google results, right? You look at what's on the first page and you don't see at the bottom that there's a more button. And if you click that more button, there's 1,000 other transactions.
That's right.
That you never see because they're, below $75, and they just make your statement go from 1 page to 10 pages. And that might even be, a good chunk of your overall spending.
Yep.
Well, super interesting, Robert. I know that there's going to be more to come there. I know we continue to uncover, interesting ways to bring some of those services in-house, and really to kind of help people graduate from the ultra high net worth, needs to something that does start to look more like a family office experience, without having to, go through the challenges and the time to spend to actually open up your own family office. And so many thanks for sharing that with us.
Absolutely.
So going back to the shutdown, a couple things that I would say I observed. One, on a personal side, for whatever reason, I actually flew more during the shutdown. I think I had 6 flights during the shutdown, and I think I had 0 flights before the shutdown on a year-to-date basis.
But how many delays did he have in those flights?
Well, and that was, every time I was heading to the airport, I was sweating bullets thinking that I might just bring a sleeping bag with me. Fortunately, I only had 1 delay, and it was an hour. So somehow I just happened to thread the needle multiple different times. And delays meaning like I didn't even have to really wait in line at security.
You just made so many people angry.
I am. And guess what? On this podcast, I am not giving away any of those secrets because the next time the government shuts down, which is probably going to be about 12 months from now, I'm going to have my cheat codes for the Intercontinental Airport here in Houston. And actually LAX, I did pretty good in LAX too, out in California. So what do the markets think of the shutdown, right? I like to talk about like what's news and what's noise here on this podcast and help people tune things out when it's not worth paying attention to, tune into things when it might really matter. What do we see? I mean, 45 days ago versus today, there's been some movement in the markets, but
I think there's been some interesting behavioral psychology. And it's funny because the CFP board always highlights behavioral psychology as the first thing to address when talking to an investor, because there's always panic and you want to try to avoid the panic selling.
Yeah, the own goals of finance, right?
Exactly. Yeah. And so, yeah, that's well said. What I would say is I think because of where technology is and the amount of information that's been disseminated, while there was a bit of a pullback, just a little one, so many advocates are out there blasting the internet with don't panic during the government shutdown. The next 100 days are typically bullish. And most people, I don't think, were panicking during the shutdown unless you worked for the government and you needed your paycheck.
Yeah.
I mean, that's really what it comes down to. And then, of course, you had the food stamp situation, the SNAP program. Those were really the big concerns. But from an investor standpoint, it was a small pullback, all things considered. And now that the government shutdown's over, we have a down day today.
Yeah. Yeah. I mean, I think just kind of watching the ticks and different little movements on the market over the last few weeks, and it almost seems like as we got closer to the government reopening, the market got less and less positive.
Yeah.
So, I would say that's at best a zero correlation event.
But at worst, it means we might need to get rid of the government.
Yeah. If they can't take taxes, earnings are going to be higher, right? In all seriousness, I think there are a couple other data points that continue to come out that I think you did see a little bit of kind of real world impact on the government shutdown, and some of this stuff is still continue to come out. But the group, or I guess the cohort that continues to take it on the chin anytime there's any kind of bad news is the lower income portion of the U.S. economy.
For sure.
And so we definitely saw that as well. I don't think anybody was in Congress was concerned that they were going to miss a paycheck. They were going to get their back pay. It didn't matter how long the government was shut down. That's a totally different discussion. But the folks that do survive on a paycheck to paycheck, or maybe they have a small kind of savings emergency fund, that's typically not going to be sufficient to cover a full 45 days of no paycheck, and even in some cases the risk of not coming back to a job, which I think there was a lot of concerns around that.
I'm sorry, I didn't mean to interrupt you there. I just had a quick question on that. Yeah. Broadly, economically, I heard whispers that the shutdown is going to hit GDP in a negative way. Do you have any thoughts on that? I kind of wanted to pick your brain on that.
I can't see how it could hit in any other way. Now, the materiality of that, I think, is questionable, and mainly because I think the majority of consumption is going to be at the higher end of the consumer. I think that's so your stores like a Walmart, right? You'll probably see some slowing of consumption in the lower end retailers. There's definitely some delays on the government contracting side. So I mean, I have friends in Virginia. I have family members that work for government contractors as well, and I think it was long enough where if you happen to have to re-up a contract during that shutdown, you were not going to be able to do that. you were going to have to, kind of sit and wait, or, some government contractors could take things on overhead, right? You know that there's work to be done. You have a high level of confidence that that work is going to be funded because it's essential, but there's no 100% guarantee. You may take that work on overhead and then kind of bill later, right? Almost like coming into work and not getting a paycheck, but assuming that you're going to get back pay. Government contractors could do that, but I don't know that all of them did. I think some of them did probably do some kind of modest furloughing or just slow down shutdowns of their own services. So that's something that could hit more on the commercial side of GDP. It's a month out of the year and then a sliver of the economy in aggregate. So, it wouldn't be a full percentage point for sure. It would be much, probably talking about basis points. Something else that we've noticed though, which I think you're going to continue to see this trend upwards in a less positive direction, would be just delinquencies. We've talked about delinquencies, I think even going back last year on credit cards and how that continues to climb. And again, it's a bit of an indicator of the haves and the have-nots and where the wealth creation has happened with, this market, which continues to be very strong. But delinquencies are still up in credit cards, auto loans, very high. Obviously there's the data on student loans obviously spiked up once those loans needed to start being repaid. But over the last month, we did see credit card delinquencies. They didn't shoot up, but they did continue to incrementally increase. And that's just data as of the end of September. So I expect that data will probably deteriorate a little bit more through October. Maybe it recovers by the end of December, which is when the next mark would be on that data. But you're starting to see, additional cracks on the lower end of the consumer. The higher end, I think home equity lines of credit are, a decent barometer there. Consumption, especially on higher end retail, is good barometer. That I feel like is still fairly robust. The data is still showing, some fair levels of kind of positivity there. Expectations broadly around corporate earnings are still pretty robust. Finishing out this year and then going into 2027. And I think kind of quarterly earnings have come out. Most stocks did a good job of delivering on estimates. There were some pockets of disappointment, or maybe disappointment is not always what requires a sell-off. Sometimes it's just not beating by enough, which will also cause a sell-off in a very highly priced, highly appreciated stock. So we did see some of that, but we also saw some pretty good results coming out of Q3 earnings. But over the last couple of weeks, we have seen a bit of a cooling off on this AI trade, right? The Mag 7 trade, AI trade. I think we lost about $1 trillion of market cap.
That's all.
Just last week. Doesn't count today. Today might be another $400 or $500 million, depending on where it ends up. I mean, $1 trillion sounds like a lot because it is, but when you're trading in multiple companies over $2, $3, $4 trillion, Nvidia I think hit $5 trillion. If it wasn't last week, it was the week before that. Yep. You can lose $1 trillion pretty quickly, and still be in a pretty substantial gains position in terms of your overall ownership of those stocks. But definitely some volatility in the market. I think there's a number of things that kind of are coinciding to maybe give a little bit of a pause in terms of the incremental next buyer to those to the Mag 7 stocks. Obviously, things that built over the month of kind of September, October, just kind of the growing interconnectedness of public and private AI companies, who's buying chips from who is issuing stock to buy chips, or who is giving up equity to get compute reserved for them for their their own modeling. So a lot of I guess a growing level of interconnectedness of kind of the technology industry in general. That's obviously a little bit concerning. The other thing that news story that came out around the guy in The Big Short, Michael Burry. Michael Burry, very notable investor, and obviously had some success predicting the last big meltdown. But people are paying attention to his short position, which was against Palantir and Nvidia. Yeah. So obviously that's going to catch a lot of people's attention, and that definitely drove a negative news cycle into an even worse place. Last week, I think The thing that's probably more material though is the interconnectedness of technology companies and how the publics and privates are starting to get to own stock in each other's companies.
I've seen the chart with all the what's it called, all the arrows showing this one's eating
there's some really
that one.
there's some really interesting ways to visualize this. I definitely encourage Google on your own time and find some of those charts. And it does start to make you think, okay, well, like where, like how could this fail, or is it set up to fail? Where I kind of look at it is the more interconnected that system is, the more you are betting on kind of a positive or negative tail result, right? That's my guess.
Well, what about Sam Altman's comments when he was
interviewed? What about Sam Altman?
Yeah. Well, he was interviewed. He's the CEO of OpenAI, and he basically was saying that the government is the insurer of last resort for every major economic hub. So like in 2008, the government came in and ensured that. Yeah. He's making the argument that AI is so connected to national security and we have to keep beating out China and other competitors that if for some reason there is a cataclysmic collapse, particularly with the liquidity that's going into financing all these developments, the government may have to step in.
Yeah.
Do you think that is a possibility?
I tried to make the same case a few years ago. I had a car that wasn't working really all that well, and I thought that it was so critical that it should get me to work every day that the government should fix it for me. Landed like a lead balloon. Just kind of making up a story, but I don't think that went over too well. I actually saw it was a CFO made some of the same comments, right? That the government should backstop, and I think maybe was struggling for the right word, and hopefully that wasn't really the intent. But those comments also did not go over well, and very quickly, our President Trump said the government is not going to backstop, the debts or the spending needs of an open AI.
Yeah.
So putting that out there, though, I think from OpenAI's perspective, I don't know that it necessarily negatively impacted their stock price because it's a privately traded company. However, I think that the follow-on effect of that would be the publicly traded companies. That's where you extract your revenge on anything that you think is kind of a negative news cycle. So that did not go over well. Lead balloon type of a comment. Philosophically, like, should the government be backstopping critical industries? You could probably make a straw man case for that, where if it truly is critical for national security, then maybe so, but that would be at the industry level. That wouldn't be at the individual company level. Like, right. For me, if OpenAI went down tomorrow, or if Grok or ChatGPT, any of those went down tomorrow, I would just use the next one, right? So, if we no longer had AI, right, if I can no longer use my chat assistants, well, that would make some impact to my day-to-day. But if I just have to switch from one to the other, I think it's, that's pretty manageable.
Well, I think the idea is that these large language models are aggregating so much information so quickly, and they're making more and more accurate inferences and leading to discoveries in so many different fields, both medical and technological advances, and even physics and mathematics, that at a certain point, the country that actually has a working AI infrastructure is just going to be light years ahead of where the next guy is, because of the way that we're able to expedite discovery in all these different fields. And I think that's the argument they're trying to make. And I'm not trying to say I agree with them or not, but I kind of want to circle back to the economics that we were talking about. Margin debt is over $1 trillion. We got increased defaults that you were talking about with regards to credit cards, auto, home, all these other things. Does this mean that we're likely to get another rate cut? Will we actually see a Santa Claus rally, or is all this negative data finally going to be negative for the market?
Yeah, so that's a great question. So let's talk about the data first. The rate cut, I think the market's pricing in still a reasonable probability of a rate cut in December. It was reduced since the last time we spoke because the Fed made some comments saying that it's going to be data dependent. It's not a guaranteed. It's not baked in. Well,
I think in that same month as well, they're stopping the quantitative tightening, right?
Yeah. So going towards easing, right? So that's, I guess, more favorable for the market. But yeah, the comments out of the last Fed meeting, the market did not like them. I don't think they were a surprise that, the Fed has never at least to my recollection in this easing cycle, said on this date we're going to ease rates. That's the purpose of their meeting, and they want people to continue to tune in, and so they're not going to give away the surprise until the day of. But I don't think it should have been a surprise that they're going to continue to look at data and not commit to anything until they see reason to do so. If you have to kind of look at, okay, well, the two things they're trying to solve for, unemployment, or I guess full employment, and inflation. The narrative from the Fed has been they're willing to kind of look at inflation that is tariff driven as, again, don't use the word, but as transitory or as one-off. Now, the ability to do that in from a data perspective, I think is fairly limited, mainly because I think it belies a thinking of how those tariffs will impact prices. And if you look again under the hood at what the data is showing, is that it has not been a one-to-one direct translation to prices. And so to be able to measure that is very challenging.
Well, I'll be honest with you, the 150% tariff on my Italian imported pasta is probably the most devastating thing that has hit my shelf in the pantry.
You're going from 1,000 calories a night to 500 calories a night.
I'm just devastated.
Yeah, I don't know how to do it. That's a tough one. That is a tough one because they do make some good pasta over there. However, on the broad, basket of consumption, I think what you've seen, and this is, consumer consumption, but also corporates buying materials to make their own goods. You're seeing, partial pass along of that, right? And so, if you think of the grand scheme of things, okay, if tariffs, let's throw a number out there. Let's say tariffs were going to drive prices of a particular good up by 10%. If that 10% is trickled out over a period of 2 or 3 years because the corporation is trying to stay competitive and they know their competitors are not going to do a one-to-one price increase, they'll eat some of that cost, then what you get is, an additional 1 to 2% a year for a couple of years. That becomes more difficult to refer to as transitory or as one-off just because of the mathematics of how that data is rolling out. And so I think, you can say that you want to make or that you want to look at tariffs as one-off, but I think doing that in practice would be really, really challenging. So that's one side of the equation where, the narrative around inflation and how they're viewing inflation might have been a little bit more dovish in narrative than it can be in practice. The reason I say that is because, the pressures on inflation, I think, continue to mount a little bit on the upside. And so that is obviously one part that they're trying to solve for. They haven't got to their target yet. Do they move further away from the target, or do they just stay equally away from the target and ignore it? I think it's possible, but there's definitely going to be some pressure for them to revisit that in the future. On the employment side, I think they're getting some leeway there because I think the employment trends, you'll probably see some data come out that will be hard to kind of dig through because data's been a little sparse with the government shutdown. Government shutdown also had people, out of work for a period of time. And so that's going to make that employment data, for sure, it'll be a little bit, I shouldn't say for sure. My expectation is that it'll be a little bit less rosy the next time we actually get a print on the employment side of things. What we've seen on, when we look at private companies and the aggregation of private company data, which is not driven by governments, that employment picture, I think, has been, fairly stable. We're seeing, We're seeing more delayed hiring, but not mass layoffs. Obviously, there's been some announcements of mass layoffs, but it hadn't been really consistent across the board. And so I think that's been more stable than trending in one direction or another in a really strong way. So long-winded answer is saying, it's TBD on whether we get a rate cut, but I think the odds are stacked in the favor of having a rate cut.
Are we getting a Santa Claus rally?
Santa Claus rally. Second part of the question. Obviously, I'm not going to promise one versus the other.
You have to guarantee it, Jake.
I will guarantee that there are no guarantees in life or in investing. I think one thing that you are seeing, obviously, the sell-off that's going on now, right? It's fairly targeted to the stocks that have appreciated the most. It's less broad-based in our portfolios. What we have seen is that, the top end, the mega caps, are seeing a little bit more reduction in their prices than the mid and the smaller cap stocks, and the low volatility stocks on these down days have held up fairly well. Sometimes they're even showing positive returns. And so, again, broad-ish based sell-off, but there are still some places to hide if you have a diversified portfolio. However, I think, your comment on do we get a fourth quarter rally, I think people would probably think about that more as, what inning are we in this AI expansion or AI kind of renaissance.
Are we 98, 99, like
97 or 99,
yeah,
right,
exactly.
is the big question. The thing, well, and the reason I think that we're having this sell-off today, or today in the last couple of weeks, is there is a growing, level of disagreement amongst the institutional investment community that we may be at 99 versus, I think, a year or so ago, pretty much consensus was that we were in kind of 97, right, to use a very general term. Now you're seeing, a substantial, not the majority, but a substantial number of institutions saying, you know what, we've come a long way. We do think, from an earnings and a revenue perspective, there's still a lot of room to go with regards to the growth of NVIDIA and the cloud business at Google and the AI business at Google and Microsoft and all those companies. And we're seeing continued deals. But in the public sphere, I think the consensus is not there yet, but is starting to migrate towards maybe we need to be just a little bit less aggressive on pricing. We have a risk appetite indicator that we track internally, when we get into the weeds of the data. And at the end of October, we're in November now, right? At the end of October, that indicator hit the highest level that we've seen since I think it was since the tech bubble, right? And
risk appetite.
For risk appetite, right? So how much return does a investor require for taking on risk? Really is kind of how you think about it. And that appetite, when that appetite is high, it means the investor is requiring less return to take equity risk. So we saw that top out in, kind of the end of October. I think it's probably come back a little bit now. Risk appetites have obviously decreased a little bit. You can see that in real time by watching the VIX or the volatility index, the volatility indicator increase, right? Which that tells us people are less likely to take risk today anyway. And so we've kind of seen that balancing out. The other thing that we've seen, though, is a little bit more of a bifurcation where a year ago, maybe you would have said, okay, well, the AI trade, everybody loves it in public markets, everybody loves it in private markets. Here you're now seeing, well, maybe people are getting a little bit, maybe it's getting a little bit long in the tooth in the public markets side of things, but deal volume is picking up in the venture space. And the number of companies that are having successful capital raises at very large, very high numbers in terms of aggregate dollars, and then also high multiples continues to ramp up and increase, especially for companies that have AI native solutions or agentic AI solutions, and you basically have to have that label in your product lineup if you're going to get any attention in the venture space. So, that side of the world is actually, I think, still looking like it's heating up.
Well, what's the typical hold time for those investors on that institutional side versus the public market side? Because if they're looking
on the institutional venture side,
yes.
So I think some investors that have made investments 10 plus years ago would still say it's TBD on the exit, but it really depends on who you talk to, and it depends on the investment that you're making. I mean, I think your typical expectation around hold times is somewhere north of 10 to 12 years because you're investing very early stage in a company and you don't want to leave until that company has some really solid results where they can either go public or get bought out by a strategic player or something along those lines. So that takes a while, right? If you look at investors that have been in the venture capital space today and that had made investments years and years ago, that hold period had gotten longer, mainly because the IPO market and the deal volume in the private space was significantly subdued over the past 5 years. We're starting to see that tick up a good bit this year, both on IPOs and just in private transactions. So you may have an optimistic view that your hold period is kind of a more normal hold period from this point going forward. But obviously, only time will tell with that.
I think that's very helpful to understand, especially if venture capital is pouring into them today and they're expecting sort of a multi-year run. Maybe that gives a little bit of a stopgap in the event public sentiment turns against AI in the public markets, just because enough capital is coming from other sources to kind of keep it afloat, if you will.
Yeah. Last thing I want to touch on before we wrap today, and is really what's going on in private credit. Since we spoke last, there's been a number of headline-grabbing credit failures that have come out. First Brands was, maybe a month or so ago now. Auto Parts, Tricolor, I think was another auto parts manufacturer, auto parts distributor. that was, kind of a pretty notable deal. And I think, the private credit market caught some stray bullets when the news of that came out. That was actually a bank originated deal. I think that the impact of that particular bankruptcy was very, very minimal on the true private credit side of the world. But over the last couple of weeks, we've seen a deal come out of HPS, which is a pretty sizable deal. That's a firm that was recently acquired by BlackRock, which, went from full kind of normal operations and normal kind of credit worthiness to zero over the period of a week or two after the loan was funded. And so that, I think, brought renewed attention to the private credit market to say, okay, well, what's going on here? Is this, again, anytime you see one failure, you're going to ask the question, is it systemic, or is it idiosyncratic, or just a one-off? And so, we're obviously doing our own research there. We did not have significant exposure to that particular deal, but we're looking at the investment processes of the funds that we do invest in and trying to understand, okay, well, are they robust to that particular type of challenge? And I think, that deal scares people because it was based on, allegedly some potential fraud, which is obviously very hard to catch.
It's a buzzword.
Fraud is a buzzword?
Fraud is a buzzword. People hear fraud, they start running.
Yeah. Oh, yeah. That's true. Yeah. Fraud will scare some people. And I think, you always want to hope, okay, well, it didn't happen to the thing that I own, so maybe my manager has a more robust due diligence process. But I think it's something that, that is definitely going to scare people in the marketplace. Now, the size of any of these deals in a private credit portfolio, not to minimize the issue, but the size of these deals is very, very small. Most of these private credit portfolios have hundreds of loans in them. Even if they're large loans, the percentage of your exposure to any one of those loans is typically less than 1%. So even with there being a meaningful failure, the overall impact of the portfolio and your ability to earn out of that loss is still pretty substantially positive. Over time, right? You always have to be thinking about it as a long-term investor. And, the other thing to keep in mind is when you are investing in private credit funds, you are taking on risks, right? There are potentially attractive returns, but you can't find attractive returns without taking on some risk. You just have to understand the risk that you're taking on. And so, while we look at the private credit space and we see that there are potentially, better spreads or larger spreads that you can get in the public space, you're doing so because you're taking some illiquidity risk, right? Your money is locked up. You can't access it in a moment's notice. And you're taking on some visibility risk. You can't always see exactly, there's a little bit less transparency when you're investing in a private fund versus like a publicly traded ETF that invests in companies that are also publicly traded or that makes loans to companies that are also publicly traded. So there's a little bit of, less transparency there. So those are all risks you just have to kind of keep in mind. But, and you have to understand, is the risk that you're taking on worth that additional incremental return, which you're capturing through a wider spread?
Right. And do you understand enough about what you're purchasing to really understand that risk in the first place? I think that's big, and this conversation comes up all the time, especially with our previous podcast where we were talking about how, alts are now available inside 401ks. Are you running due diligence to understand what risks are really behind these things? I think that's all the more reason why you need to make sure you have the right team behind you to make these decisions. Yeah,
somebody needs to be in the decision loop, right? That has the expertise, that can help you if you're not the expert, that can be an expert for you, be your advocate. So we try to do that for our clients to the best of our ability. I think, there are other people that do that well as, in addition, but you definitely don't want to go it on your own unless, you're quite the expert in the space.
Well, if people wanted to figure out how we do it and how to make those decisions, where should they go?
That's a great point, Robert. If you guys want to take the discussion any further, just come visit us at avidianwealth.com.